Good morning, everyone, and good morning to all our panelists today. Very exciting to be the first panel session of the morning. Okay, so before we kick off, I'll set the scene a little bit. So according to the big deal, in absolute terms, the fintech sector experienced another serious drop in investment in Africa in 2023. So from 2.4 billion in funding raised in 2021, it fell to 1.8 billion in 2022, and now in 2023, it fell to 1.2 billion. But given the generalized slowdown across all the different sectors, fintech's relative share of overall funding actually increased a tiny little bit to 41% last year. In 2021, fintech represented 62% of all funding. And in 2022, according to Brighter Bridges, it was 38%. So a slight increase to 41% in 2023. In terms of the number of ventures having raised 100K or more in 2023, fintech represented 24% of the total. And according to Partech's 2023 report, they see it slightly differently. So according to Partech, fintech held its position as the leading sector in the African tech ecosystem, as you know, attracting 852 million across 113 deals in 2023, despite the slowdown. Partech, however, also highlights the relative increase of upcoming sectors trading right behind fintech. So the steady increase in investment across fintech and the logistics and transport sectors. So very excited to have our excellent panelists here today who are right in the thick of everything that's happening in fintech in Africa, and really excited to hear your perspectives. So my first question today is going to Ngetha and to Andreata. So in the booming years of 2021 and 2022, there was a lot of competition among VCs for opportunities in fintech. And you guys as VCs, you guys are price takers more or less. But now with the change in the investment climate, you guys have more of a negotiating power, more negotiating leverage. How have you experienced this change? And if you could put a number to it, by what percentage would you really say that these valuations have changed? So I'll start off with Ngetha, then I'll come to you.
Hi, thank you very much. So first, just a word of introduction, my name is Ngetha Waithaka. I'm a partner at Roskeng 22. We're a $200 million growth stage fund investing in sub-Saharan Africa. We're pan-African, but we've got offices in the big economies of Africa. Well, thanks first and foremost for having me. This is the first time I've ever gotten the first panel, so my social capital is definitely on the rise. Thank you very much. So let me just, to your question, let's start with, look, I'd say valuations have been contextual, right? If we look at what happened in 21, 22, and remembering that private markets never divorced from private markets, we had the wave from COVID to, call it end of 2022. I think the Nasdaq went up almost 2.5 times on the back of mostly cheap fiscal and monetary stimulus, as well as a wave of digitization. Right? So everything went a certain way, and there's a lot of IPOs that were being done at crazy vertical. Now, reality has to set in sometimes, and we are very glad that it happened. And so, we've seen, I never forget that, I remember there was a time when SaaS, enterprise SaaS businesses, which had traded on average, call it 5 to 7 times over a 10-year period, the top 25 percentile was trading at about 30 times revenue. Now, as an investor, with a person who has a pool of capital to invest, you're forced to believe that things are good and will continue that roller coaster. But I think prudence is required in moments like that. So, I'd say it's good that double dropped and we went back to the 20 average multiples. And I'd say, look, I still think there's a bit of pain to have in valuations, especially on the fintech side. And the other thing I'd say, if I just look at last year, I'd say on average, probably a 30-40% decrease. And there's a difference between what's happening at later stage than early stage. So it's not equal for all boats, but I would say that one could see about a 30-40% drop in valuation expectations. Now, our founders are not super happy with that, but flat. Yeah. So yeah, over to you, Enza.
So I think what I'll do is I'll complement what Ngetha has said, which is I think many times we just focus on valuation, but I think in the context of investing, there are many things, right? So a few things either went out through the door in 21, 22 when there was above capital. So it wasn't just valuations going up really high, it was the lack of thorough due diligence by some investors flying in, flying out, so not doing proper due diligence as they were investing. And even also, I think a level of not committing to helping and working with a company. So if you say, for example, you're a large billion-dollar investor in Silicon Valley, Africa sounds interesting, you're getting priced out in the US, let me see what I can find in Africa. You know, there was also a piece of they were not taking books. So it's just one of many, it's a rounding error for them, right? And then the other piece that went out through the door was governance in terms of just kind of how do you set proper governance in place, you know, making sure that you have a proper board and just the things that you need to run a sustainable ecosystem. So a bunch of that stuff went through the door and we were looking like we're old fashioned, like what is wrong with us, right? So much of that also has come back, which I think is great because I think that's what we need to build a long-term sustainable ecosystems. For us, we live and die investing in Africa, right? So we're committed. We take both seats. We work alongside our founders, and I think that's good that that's coming back as well within the ecosystem. Outside of the fact that it's great that valuations are also getting back to kind of pre-hype numbers, which I think is good and sustainable. I think the challenging thing, of course, about what's happening right now is that there's no capital. There's not enough capital anymore, especially on the latest.
Thanks, Andreata, and thanks, Ngetha, for introductory remarks. So I'm going to move over to Edmund and to Ivy. So Ngetha, you just mentioned from your perspective, you're seeing about a 20 to 30% drop in valuations. And of course, this is different between whether it's early stage or late stage. So Edmund and Ivy, I'd like you to give your own perspectives of what you're seeing at Verdant. And also, please do introduce your companies and what you do. And I'd like to understand, now that you're in a position where you guys are having to do the calculations now, the market hasn't set the price, you're not just accepting what's given to you, you're actually having to think through and do the valuations yourselves. I'd like to understand how you're doing this now in this current climate and what your approaches are. So Edmund first and then Dan.
My name's Ed Higenbottam. I'm Managing Director of Verdant Capital. Verdant Capital is the manager of the Verdant Capital Hybrid Fund. We invest junior debt, we invest senior equity into growth stage tech-enabled financial services companies. We have a separate business within our group called Verdant Hybrid, which does M&A across tech, financial services fund, and in the private equity community. I think I would concur with a number of comments that changes in valuation. I think valuation may be down by slightly more than 30 or 40%. I think someone might slightly flippantly say 2023 or 2024 is all about halves. If you compare that 2023 to 2021, valuations are down by half, deal sizes are down by half, and the number of businesses getting funded versus not getting funded is down by about half. And I think actually entrepreneurs and venture businesses have really felt the pinch over the last 12 months or so. You actually look at the statistics, the amount of funding has gone down only by half between 2021 and 2023. I think a lot of people feel, well, actually, it feels like more than half. It feels worse than that. And the reason for that is quite simple, is the cohorts are bigger. The cohorts of Series B companies, i.e. people who raise Series A, that's bigger than it was 24 months ago. cohort of companies who are in late stage who raised pre-seed rounds 18 months ago. That cohort again is bigger than it was. Those cohorts are bigger than they ever were. So those declining volumes in nominal terms are declining volumes versus much bigger cohorts. So everybody's feeling the pinch even more than some of the statistics on the tables. I think diligence, very, very important comment. I think there are a lot of companies who got funded in 2023 and got funded in 2021, late 2022, or got funded in 2020. A lot of companies got funded who probably shouldn't have got funded. And a lot of valuations were insane, candidly. And I think we've got a lot more professionalism into the market on both sides of the table. And I think that's a good thing. I think where we sit today is there's a lot of businesses who have done very, very well. No ifs, no buts. And what I'm saying, I think there's different challenges of different types of businesses today. There's challenges for everybody. So I think there's some businesses who've done really, really well. No question. They've hit their numbers. They've delivered on their promises. But then as they grow, there's not enough later stage capital for these businesses. And how do they raise capital now? The tourist capital from the US, to what extent has that been burned by the deals that were done for haste without sufficient thought 2-3 years ago? Can they raise capital from the traditional private equity community? Should they be looking at options like Verdant capital in terms of debt funding or venture debt or mezzanine capital? You've got a lot of businesses who've done okay or done reasonably well that have been hit by macro headwinds. I think Kenya is a great example of that. In Kenya, last 10-15 years has been a very strong economy, has grown every year. Living standards have increased. There's been a flourishing dynamic market, but we've been hit by a lot of headwinds in Kenya over the last 24 months, and a number of businesses have been hit by that on the credit side, on the logistics side. And these are good companies with good products and good ideas, but the room for maneuver is different. Is there an M&A route for these companies? Should they continue to go down the financing route? And then there's a number of businesses who haven't done very well, and a lot of those companies, it's a choice of do we close up shop, or do we try and find a buyer, and what are the solutions for us? Do we close up and do something else and move to different parts of the world and fly all over again, or do we try and find a buyer, and do we try and find a new business model? And so 2024 was to look ahead over the next 18 months. There's lots of different interesting businesses looking for different types of answers. I think it's a very, very interesting time.
Thanks, Edmund. Over to you, Ivy.
Hi, everyone. My name is Ivy Macharia, and I work with Enza Capital. I used to that invest in category defining businesses that are looking to solve some of Africa's lives. So we are a multi-stage sector agnostic fund, but we are a lot at the city. So as I talk about what we've been seeing in the valuation space, I'll really focus a lot on this early stage, especially because I have kind of colleagues on the panel who are more pro-stage investors. And when it comes to valuation and how we've been thinking about it and approaching it, I wouldn't say that like the current down market has changed much in how we approach it. Even in the hot market in 2021 and 2022, we would still really like approach valuations from a fundamental point of view, try and drive the conversation towards, okay, so what do the multiples say? What are kind of more fundamental methods focused on the revenue, on the cash flows, and also what the market is showing in terms of medium valuation. I think what's changed in this market, the fact that we are now able to, as we learned from being price takers to being able to actually drive that direction of conversation as an investor. So at the stage that we invest, a lot of what happened, I would say between 2020 to maybe early 2022, is we saw lots of businesses raise sometimes significant amounts of capital and structure at safes with pretty high caps. And for lots of these kind of pre-seed, stage businesses. Their hope was that they would think to convert safes at the caps, at or near the caps. And what the market is starting to show is that the valuations are much lower. The premium they can get from one round to another is very small, really premium at all. And some of the roles that we're really playing with companies in our portfolio and also with we're looking at is bringing that sophistication of, having the conversation. So the market is what you expected. You're being priced at a much lower valuation. And what will happen is that as these safes convert at lower valuations, as founders, you're getting diluted much more than expected. And so one of the ways that we are having this conversation is trying to see how do we balance what the market is saying and what is the reality, with ensuring that we're investing in businesses we are founders that incentivize to still hold enough stakes that incentivizes them to solve these large problems for their business. And I think what I'd say to founders who I know there's a lot of room is right now the market is one where you need to continue to focus on capital efficiency, do much more with the capital that you raise. And when you go out into the market and find a difficult market, you still do need to close the deal to extend your runway and survive this cycle. And so have those conversations with the investors that you're coming across on what are the ways to balance this reality and continue to ensure that as a founder you're incentivized. Are there ways to set up size this up so that as founders you're also able to earn back some of the capital that you lose to dilution and make it out of the cycle? Because at the end of the day, what's important is continue to build and grow drive the businesses and make it across to the other end of the current market cycle.
Thanks, Ivy, and thanks for also opening it up to your advice to founders, because of course there are lots of founders in the room and around today. I know there's a lot of noise outside, so hopefully we can keep the energy in this room. Soji, I'd like to come to you and to hear about Absa's perspective, more from the capital market side of things and looking at a later stage and potentially even from an M&E perspective, how you're seeing the impacts of the slowdown on the fintech valuation.
Hello. Okay. Good morning, everyone. I'm Soji Solanke and I work with Absa. Absa probably banks a number of people in the room, so thank you for being good clients. So basically with Absa, I head up our fintech investment banking and origination team. And what that simply means is working with our fintech clients on M&A, but also capitalism opportunities, whether that's equity or debt in public or private markets. So the question is along the lines of what's been the implications of what's happening in the tech space, or whether it's listed companies or later stage type of opportunities. I would say that the dynamics for Africa have been fairly similar. Okay, so if you look at some of the listed companies in the fintech space on the continent, valuations have also pulled back quite meaningfully. One of those companies is, for example, Fintech listed in Egypt. I used to cover it in my former life, and valuations have pulled back quite significantly. Part of it is partly because we've seen interest rates going up in developed markets. So what that has also meant is a number of the frontier market investors that had allocated capital to these regions have pulled back, to focus on some of their core markets. And I think also the macro challenges in some of these countries has not been helpful. Okay, so currency devaluation, being a significant issue, specifically, has not been helpful. But at the same time, another interesting company in that market, which is Egypt, is eFinance, right? Another company which was IPO towards the end of 2021, probably the largest fintech IPO ever in Africa. That was done in Egypt. But you see there, the valuations have pulled back, but not as aggressively as some of the other companies. And maybe that's because this is more a B2B type fintech business. But at the same time, it has a captive client in the government of Egypt. Okay, so it has there are certain types of businesses which it does, which is fairly stable and captive. Right, so that's the dynamics for a business of that nature. But I think with all of this having been said, with some of the later stage conversations that we're active with, and I think some of those would include companies trying to IPO, what we're finding is let me put it this way. The reality of IPOs is that there's a lot of preparation required. Okay, the local exchanges, the extent of depth that these exchanges have to be able to handle the types of valuations that some of these companies would like to have, an interesting question to solve for. Okay, so what we're trying to do is to work very closely with the institutional investors in some of these markets to help them understand some of the dynamics of these tech companies. Because it's one thing to have the idea that you want to list your business, but if the investor community does not understand your business dynamics, because there's never been a company like yours getting listed on that exchange, you probably struggle to get the type of valuation that you want. So there's a lot of teaching process, hand-holding that's required before you ultimately get to an actual transaction. So there's a number of these things that we're actively busy with. But I think maybe the final thing to say here is the implications of interest rates going up around the world has also meant that a number of the tech companies that had raised debt funding, I think in Rolake's opening speech, he did mention that, debt has played a more significant role in the funding on the continent. A decent portion of that has been in dollars. The types of things that we're now seeing is there's increasingly more demand for local currency funding. And at Absa, the types of things we could potentially help with could range from balance sheet funding opportunities, but also debt capital raising opportunities. And I think there's some of the funds on this panel where, some of their portfolio companies, we're trying to have some of those types of conversations with. So that's the range of things that we do, but it's a very interesting environment. And I think ultimately the solutions as advisors that we'll need to bring to the ecosystem will need to be very tailored, because the dynamics in Africa are somewhat unique, given the funding landscape, the exit opportunities, and also the roles that strategics can play to provide exit opportunities for some of these companies. So there's just a lot of nuances to solve for within the ecosystem.
Thank you, Soji, and awesome to hear you say IPO so many times, because it's almost like IPO isn't a thing anymore. So nice to hear you repeating that it's still an option for exit. But I guess what most of us are more familiar with is corporate acquisitions, more of an exit opportunity. And we're really lucky to have such a variety on the panel today. We have a really great vantage point of what's happening across the continent. So I want to dig a little bit deeper into the differences that you're seeing between early stage and late stage. So Andreas, I'd like to come back to you on this and get your perspectives.
So I think we think about from the capital markets perspective, I think there's still significant capital at the earlier stages. So within the pre-seed and seed rounds, there's sufficient capital, I believe, in the ecosystem. Where there's the real gap is Series B, Series C. Because if you look around Africa and you're like, okay, so which funds are larger than, $60 million? It's probably 6 or 7 funds. Ourselves, Northgate, Partech, Enza, and a few lower stars. So they're not, I can't even fit them on my 2 hands, right? And this also which is not new and surprising because this was the case, but the difference now is that this part of the later stage capital was being covered by global investors. So whether it's Goldman driven, Tiger, Target Global, and the likes, and all of these have now retreated. So now there's a bit of a gap there in terms of who can lead a $50 million round on the continent, and there are just not that many that are there. But I think all is not lost, is my view, in the sense that I think capital is still capital in the world. There's still we've just we have a number of funds have recently closed. Funds north of 100 million. So there's dry powder. So people are investing. We are investing, actively investing. And the question, and capital needs to find a home. So yes, their interest rates are higher. But if you have an asset, if you have a company that's creating value, that's growing and that's scaling, you'll be able to raise. So I don't think, if you think about Africa Tech Ecosystem, in 2016, for example, it was north of 200 million that was raised. but the entire ecosystem. Then we went up to 5 billion, 6 billion. So it's not that, so there's still a 10x growth. Yes, it's lower than the previous years, but there's been significant growth in the ecosystem. So yes, there is, challenges on the later stage. You need to do a little bit more work to find capital. It will take a little bit longer, but I think the opportunity is still there.
Thanks, Andreata. And back to you, Ngetha, on the same question.
What I would say about the later stage is, again, timing is not very helpful to the founders who are around in 2020, 2011, 2020, 21, 22, because you see, the players in the ecosystem were sending some very conflicting messages, yeah? A lot of investors were saying, you know what, you build it, growth, we shall come, we shall fund it, and we shall fund it at all costs, yeah? So, a set of companies really ran out ahead, high customer acquisition costs, high burn, and then, as this had happened, schizophrenia set in, markets changed, investors said, you know what, I want capital efficiency and profit. I want it to be sustainable. So what do the founders do? They now start cutting back, chopping and changing our business model. Pivot became the best new word. And what we realized is some businesses have gone so far ahead that they have to keep raising. So the businesses that come to us today that were funded in that crazy period have to raise. They have to take a discount. It's not an option. You either shut your doors or you accept whatever valuation the investors were out there. So to all investors in the room, my advice would be, look, you've incubated the business in an African environment. One, you are most likely more capital efficient than most other parts of the world. Please stay that way, because only 1% of global venture funding comes onto our continent. Don't expect that that's much is going to change to 10 to 20%. Capital efficiency is probably the most important thing, and the one asset that you have second to your skills and ability to drive a great enterprise. Yeah? So one piece of advice and one response to answer.
Super helpful. I think we have about 15 minutes left, so I'm going to open it up to questions in about 10 minutes. But I want to come back to something Andreata said. So there's still dry powder, there's still funds raising and closing large amounts, so there's still money to be invested. And when we look at Africa and we compare Africa with where we were in 2020, it's actually been huge growth in the overall VC investment space. So the statistics from Big Deal again, Africa's VC funding overall increased 76% from 2020. And then when we compare this globally, what we're seeing globally is that there's been a drop in North America by 14% since 2020 to now. In Europe, an increase of 12%, LATAM a drop of 43%, and Asia Pacific a drop of 39%. And this is comparing to an increase of 76% in Africa, also from a lower base. So what I really want to move the conversation to right now is to understand, is what we're seeing in Africa any different to what's happening elsewhere in the world in terms of fintech valuations and the bearishness of the current fintech market? And I'd like to come first to you, Andreata, and then Soji.
No, it's not. Like, this is what's happening globally. I think also the way to think about it is, to your question earlier around valuation. Like, when we're thinking about valuation, is that, so you're thinking, okay, how big can this business be a couple of years out? And then at that stage, how do I exit it? And when I'm thinking about how do I think about pricing that, then I look at the public markets, right, and see, okay, so what are the multiples of the public markets? What's happening in the private markets? So public markets are down, right? So valuations have been readjusted. So that all cascades back into the earlier stages, and that impacts the valuation right throughout. So and that's what's happening globally. So there isn't a significant uniqueness in our ecosystem. I think also part of it is the fact that because we got the benefit of some of the global capital that was coming in, now that capital is pulling back, and there was a significant amount of global capital. Because if you think about, okay, how many Africa-based funds are there, relative to the amount of capital that was raised. A significant amount of that capital came from outside. So of course, then what's happening globally is also impacting us. I think also more for us, more so because it's an earlier ecosystem compared to Silicon Valley and the rest of the others. So yes, there's some level of what I call base capital, which is your Africa-based funds, but we need more of those, and we need more capital that's dedicated to Africa so that we can sustain the ecosystem.
Okay. Look, I think in terms of the some of the listed fintech companies around the world, the dynamics affecting their valuations are somewhat different from what the discussions in the private capital markets are. And I think some of the issues here would include, for example, what's happening to interest rates, right? So yes, it's had a role to play in what's happening in the private market. So if you look at Brazil, for example, what were the issues that affected a company like, Stoneco, for example, listed in the US? And the issue there was that they had a loan book, right? And naturally, as interest rates went higher, increasing concerns around the ability of their merchants to pay, when they lent money to them, right? But luckily for them in Brazil, the central bank was very ahead of the curve in terms of trying to tackle rising inflation. So they increased interest rates very aggressively, multiple times. I think this was in 2020 or 2021. And because of that, you saw the implications for valuations for a listed fintech company like Stone. Okay. On the other hand, if you move more to Western markets, the dynamics there were more around, post-COVID delivery in terms of revenue growth. Okay, so during COVID, some of these fintech companies, they benefited from the tailwinds of changes in consumer behavior, but that led to a much higher revenue base, such that the ability to continue to grow at that same rate was more challenged post-COVID. Okay, so what happened last year? We started to see companies like Adyen, Worldline, Cap Payments. I mean, there's a couple of these names, and what happened? They made adjustments to their revenue growth guidance, and what essentially happened was that the market punished the stocks. Okay, so not that these companies are no longer growing; they are still growing, but they are just growing at a relatively slower clip compared to what they grew at before. And the response of public markets has been that investors have just sold the stocks very quickly in response to that. And I think also because now, if you look at the latest inflationary print in the United States, the outlook is such that perhaps for this year, inflation remains somewhat, at current levels, unlikely to decline further, which also just simply means that the central banks the Fed is likely to hold interest rates at current levels, which also has implications for valuations. Okay? And the final thing to just say is, I'm trying to paint the picture that it's not a one-size-fits-all dynamic affecting valuations in public markets. You really need to look a little bit deeper. But from an Africa perspective, what you also then find is the valuations for the listed fintech companies in Africa relative to the valuations for traditional payment companies, excluding the card schemes. The African fintechs actually have a higher valuation. Perhaps because they are delivering higher growth than what you find in some of the European payment companies. So some interesting nuances. Valuations are pulled back. They also still find that despite all of that, African fintechs delivering higher valuation multiples than what you find in some of the developed markets. And the final thing to just say here is there's one unique thing which we found from a valuation perspective, which is when things were quite frothy, a lot of revenue multiples were used in valuations for tech companies. From a fintech perspective, what we found is it's actually more important now for you to go beyond just revenues and actually decipher what exactly is this company calling revenues. Because very often for fintech companies, there's a lot of payouts of revenues to third parties. Because fintech companies are using all sorts of counterparts to deliver their solutions. So the revenue number you're working with, is it true revenues for that company? I can give you an example, a company that sells airtime. If you're taking the role of principal or agent in that transaction, it affects your revenue number. Okay? If you're an agent, you end up with a gross margin of 3%. If you're a principal, you end up with a gross margin of about 3%. Okay? If you are an agent, you're reporting your actual revenues as revenues. So ultimately, from an EBIT to revenue perspective, the agent has a much higher multiple than the principal. Okay, so if you're not really deciphering what you're using for the revenue multiples, you end up with a wrong valuation for your companies. So those are just some of the nuances which we've tried to pay a bit more attention to in public markets for some of these fintech companies.
Yeah. Sorry, just one more point, which is I think Edmund had alluded to, which is around the macro. So if you think about a fintech company in Nigeria, where the exchange rate has gone from 490, now it's 1,000 going on to 1,400. So there's also a double hit, right? So you're hit on the multiple side, but also you're hit on your revenue side, because as investors coming in, they're looking at dollars. So your dollar value, yes, you've grown, 3-4 times, but the devaluation catches you. So that also has an impact on company valuation.
Anyone else want to come back on that? Okay.
I think there's a number of businesses who are into that growth stage, access to debt market. And I think people are quite often think about that conveyor belt of angel, pre-seed, seed, A-seed. And quite often they think about that in terms of equity or safes only, and they don't look at more traditional debt funding or mezzanine funding. I think a lot of the business models we particularly see in fintech, including credit models, the success of those credit models really lies on the ability to, over time, replace the equity funding or debt funding. And equally in the payments market, a lot of these payments businesses, as they grow and they mature, they start having quite significant balances of float funds. So, for example, businesses such as eBay has been very, very successful, it's very profitable. But over time, its float funding requirements become larger and larger, and we're one of the debt investors that's actually supporting that business. And as the optionality around equity or potentially the availability of equity becomes more scarce, as capital requirements almost outgrow the market. Some analysts have made that point. It's worth keeping an eye on that, worth businesses and CEOs and entrepreneurs keeping an eye on that option.
Thanks for that, Ed. So we're opening it up for only 2 questions because we're at time. But while we get these questions, I have you guys are quick. Question over there.
Hello. Hi guys, sorry. My name is Trevor. I'm the CEO of Alpha Block. We're bringing real world assets onto the chain to improve efficiencies. What everyone has said is really resonated with me because I'm a seed stage company. We raised our pre-seed about a year ago, and naturally it's been a slow, painful process. But I agree with what Soji was saying about the markets having certain niches. And my question goes to Andreata. I wanted to understand, we have the niches where certain companies are growing in value. So certain tech industries are growing in value, even though the total capital markets are going down in valuations. Do you factor that into how you are assessing the seed stage companies you invest in? And do you also think about how much efficiencies these type of companies will get within a 3-year period with the AI inventions that are coming out for our business models, so that we assess whether this is the right valuation? And as a seed stage company, would I need to be thinking about profitability by the time I'm getting to Series A because of the risks that most of the Series A and B companies have been facing? Thank you.
So on your point around valuation, it's definitely nuanced on a company to company basis for sure. Because even in this market, there are companies that are raising and investors are all over because it's a very attractive investment. So yes, there is definitely nuance, and you factor in, the potential upside based on the sector, based on the market, the company, potential exit opportunities for the companies. So yes, there's significant nuance on that. In regards to profitability, so what I say there is, what matters to us is that the unit economics makes sense, right? We don't need you to be profitable tomorrow. We don't need you to be profitable next year. But the unit economics of how you're serving your clients needs to make sense, because there's always a trade-off between growth and profitability. Because if you're pushing for profitability next year, that means you're not plowing in resources to be able to grow and do scale. So, in fact, we saw this happen when the downturn started, where now entrepreneurs were showing up with business plans where they're like, if everything works, I'm going to be at $10 million in 5 years. That's great, but it's not very attractive for me as a venture capital investor, right? So I think of course, there's a balance you kind of have to tread as an entrepreneur, but to get us, venture capital is pretty unique, that we're looking for high growth opportunities. And the capital that we bring in is capital to fuel that growth, but the unit economics needs to make sense. I think the challenge that was happening in 2021, 2022 is that businesses were being funded where the gross profit margin was negative in some cases, and there was no pathway to profitability. So that was where the disconnect was. It's not that now all companies should now go to profitability. No, I don't think that's the right advice.
Yeah, disagree.
One of the ratios that we look out for businesses at A and late seed stages is the ratio that we call the burn ratio, and it's the overheads divided by the total gross margin. And one of the rule of thumbs that we look for is 1.5 or less. So your overheads versus your total gross margin, gross profit is about 1.5. So, if you double your business, your overheads are not going to stay flat. They're going to go up a little bit. They're going to go up by 5. If you double your business and your burn ratio is 1.5, you're going to either be at break even, fairly close there too. And I think as an entrepreneur, I think that's quite a good number to track and have on your radar screen for the coming 24 months.
Ngetha.
Yeah, what my advice for you would be, just think about who you want your investor to be. You can grow a lovely family business that is profitable from tomorrow, that just continues peaking along. From a venture capitalist perspective, that is not what we're looking for. We're looking for the special. We're looking for outsized return on a risk-adjusted basis. And for that reason, we want you to dream massive. And if you just think about it, from a seed stage, you want to almost be swinging for the fences. You want to make sure that this opportunity, I can put together a team, go after an opportunity that will deliver the type of results that a venture capitalist is looking for. Yeah? And for that reason, I'd encourage, at that very early stage, you are trying to conquer the world, not average, not a family size business.
Yeah, go ahead.
Just one quick point. I love being in touch with the VCs, right? Because they give really excellent advice to the portfolio companies. I just wanted to give 2 clear nuances, which is that in an African context, there is no listed fintech that is loss-making. So what does that mean? If you are thinking your exit pathway is public markets, you better make sure you are trying to build for profitability. Because the investor base is not at the stage yet in Africa where they are willing to fund loss-making listed companies. The other example is maybe Lesaka in South Africa. Unique situation, okay, but important context to keep in mind. The other thing to say is that if you are loss-making, you probably want to explore more the strategic sale, if that's your exit pathway, okay, outside of an IPO. What that also clearly means is we have not seen a lot of strategics acquire tech companies. That's just the reality of things. So what does this mean? Like Ngetha said, you really need to build a very focused business where your value add is extremely clear. What exactly is the value that you're bringing to the strategy for them to realistically consider you for an acquisition? Okay, so just 2 important points to keep in mind in the grand scheme of all of these things. Yeah.
Thank you. And thank you all for being on this panel. We can't take any more questions, but the panelists will be around afterwards, so you can corner them. Probably have to be very quick. But to round up, the perspectives being actually the drop in fintech valuations, perhaps 30 to 40%, is not such a bad thing. It's led to more realism in the market, better professionalism, and more corporate governance. And there's still a lot of dry powder to invest. So there's still some optimism in the fintech space in Africa. So thank you.